thank you so much for that. And thank you everyone for joining as well. I'm really glad that you're all here and we're hopefully going to shed a bit of light on pensions. So I'm going to share my screen with you so you can see what we're talking about. So let's go. So pensions demystified. Before we kick off, as Liv said, I'm Ellie. I'm a financial coach and educator, and my purpose really is to help people to understand money, make it make sense a lot more, and hopefully that's what we're going to do today. So what we're going to cover over the next half an hour or so is what actually is a pension, because it's one of those words you hear a lot of the time, but it's not always clear what that actually means. Why do I need a pension? Why should I start saving for retirement now? Is my pension doing any good? And help, I've lost my old pensions. So let's get going. So what actually is a pension? Well, it's really quite simple. A pension is a pot of money that you set aside for later on in your life when you retire, and it's there to provide an income for when you no longer work. That's whether you no longer work because you're older, whether you don't want to work because you've worked for long enough. There are several different reasons why you might want to retire, but the pension is the pot of money that you're putting aside for that time so that you can have a good time, hopefully later on in life. So, why do you need a pension? Well, the main reason is there is a state pension, and we'll talk about that in a minute, but could you survive on £9,350 a year? I think the answer for lots of us is probably a no. But if you just break that down and think about it, that is less than £1,000 a month. And of course, when you're at pension age, you're in a slightly different financial situation to a lot of us might be now, but the state pension is £9,350 a year at the moment. So unless you put aside money throughout your working life, then that is what you're going to be living off. And at the moment, you only get that when you reach 66, but in the next 20 years, that plans to be at least 68 years old before you can access that. So if you want to retire earlier than that, and if you want to retire with more than that, then a pension is a reason to, well, a pension is a way that you can facilitate that and put money aside now to fund that later life and to provide that income. So, as I mentioned, there are 3 types of pension in the UK. So we'll start off with the state pension, as I just mentioned. The government gives you a regular payment based on your lifetime national insurance contributions. And that is that state pension that I just mentioned. So that £9,530 a year. To make sure that you get that full amount, the government will look at your national insurance contributions, which if you're on payroll, you will automatically be contributing to. However, if you're not on payroll, it is worth checking and making sure if you've had any break from employment that you have got 10 years of national insurance contributions unbroken, because that is what you need to make sure that you're qualifying for your pension. You can make those payments up if you have missed any time. For example, if you've been on extended maternity leave and you've not been making those contributions, but it's something to think about like earlier rather than later, and make sure that you've got those insurance contributions made so that you can access that state pension. So other than the state pension, we've got 2 types of pension. We've got a workplace pension and a private pension. So a workplace pension is a pension where you contribute typically at least 5% and your employer contributes typically at least 3%. I'm here just to clarify, talking about a defined contribution scheme, which nowadays are the most common pension schemes. However, some people here might have a defined benefit scheme, which is a very different type of pension scheme. For the purposes of this conversation, we're talking about defined contribution, which is where, as I mentioned, you contribute and your employer contributes. So as of a few years ago, then you have to be automatically enrolled into your workplace pension after a probationary period if you are 22 years old or over. And the minimum contribution is 8%, but lots of employers will offer you more, and they will offer, for example, if you contribute 7%, they'll contribute 7%. So it really does depend on your employer, but you should be getting at least an 8% total contribution. And on top of that, you do also get government contributions by way of tax relief. So for every £80 that you pay in, the tax relief, if you're a basic rate taxpayer, means that you get £100 into your pension. So that's a workplace pension where you get those contributions from your employer. But you can also have a private pension. And a private pension is effectively a scheme where you contribute however much you want, however often, and you still get the tax relief benefits that you get with a workplace pension. So you have an annual allowance that you're allowed to contribute. You often can have more choice when it comes to personal pensions about private pensions, about where your investments are being made. And we'll talk about that in a second. But a private pension is an option if you want to add more through a scheme which is different to your workplace pension and you want to build up that pot for your future. So we've got those three types: your workplace pension, your private pension, and your state pension. But you might be wondering why it matters. Why do you need to start if you're in your 20s, 30s, even 40s, because you're not planning on retiring for a long time? Well, the reason is that pensions are investments. So pensions are typically invested in stocks and shares by your pension provider, which means that when they're in there, they're going to benefit from compound growth. So stocks and shares, so if you've ever heard of the stock market, then that is where your pensions typically are invested. Pension providers have a huge range of funds, which are effectively selections of investments, which all have different levels of risk. So some of them will be stocks, which are slices of companies, which will be traded on the stock exchange. And some of them will be different assets like bonds, which are effectively corporate IOUs. So they're loans that you give to companies. And these pension providers will create these funds and put your money into these funds to try and make it grow. And the big benefit of investing, which pensions are investments, is that you get that growth. So compound growth is growth that you earn on gains that you've accumulated previously. So it means that your money, when it grows, that growth is reinvested. And so you've got a bigger amount to grow again. And that happens over and over and over. And over a long period of time, you can end up gaining a huge amount of value in your pension pot without actually having to do anything. On top of that, auto enrollment, as I just mentioned, the compulsory enrollment of employees who are past probation, earn over a certain amount, but that amount is relatively low, and who are over 22, means that if you contribute to your pension, your employer must also contribute that minimum 3%, which is the closest that you're often going to get to free money. So you contribute, they contribute, and it goes into that pot and starts building for your future. So the longer that money is in the pot, then the more time it's got to grow. And you can't access a workplace or a private pension until you're 55 at the youngest. As I mentioned, the state pension is looking like it's going to be at 68 very soon. But you can access those private pensions at 55 typically. So it's worth thinking that you've got a fair amount of time that you can really build a good amount of money for you to live off once you do stop working. So this example here, which is from a website called Unbiased, shows you what can happen if you start early. So as you can see here, it's a basic rate taxpayer example who contributes £250 per month into their pension. So this is assuming 6% annual compound growth, which is relatively conservative. So you could expect to see returns of 6%, if not more. But if you start at 25, by 65, if you retire then, you have £622,340 in your retirement pot. But if you start at 55 and contribute that same amount, you're going to have a fraction of that at £51,000. So time really does help. And even with that conservative 6% growth, you can see how much your money can really build and provide you with that income when you're a bit older. So although it might not seem like something that you want to prioritize right now, it is something that is really worth thinking about doing as soon as you can. So what are the major perks of a pension, and why is it important that you think about pension rather than simply investing in stocks and shares? A lot of people often ask that question. If they're the same investments, then why use a pension? Well, the first reason is that tax relief. So as I mentioned, for basic rate taxpayers, if you pay into a personal pension or an employer pension, that workplace pension, you will automatically get 20% tax that you would normally pay back from the government into that pension pot. So that is automatically boosting your pot. Secondly, we've got tax-free growth. So a pension is a tax wrapper. It means that within that pot, then your investments will grow and the growth isn't taxable, which is awesome. So it means that you can make growth without having to pay extra tax. And finally, you can take a tax-free lump sum. So typically this is 25%, but it does sometimes vary. But when you retire, if your money is in a pension, then you are able to take 25% of that pot out as a tax-free withdrawal, saving you from income tax. The rest of that money, the 75% remaining, you can have different choices about what you do with it, but you will pay income tax on that. But that 25% you can take out without paying any tax. And that only applies to a pension. So there are some really compelling reasons to put your money into a pension, because you're going to get a lot of benefits and tax breaks and tax reliefs from doing that, as opposed to doing other things with that money. So those are obviously the really positive sides. You get money from your employer, you get a tax break, and you also can avoid having to pay any income tax when you take money out of your pension at 55 or above. But there are some downsides, which is important to think about too. So the first one is the lack of flexibility. As I mentioned, you can't access that pension until you reach typically 55. For the state pension, it's 66 going up. So the only circumstances where you can access that money normally before that age will cost you a lot. So there are huge fees and tax implications of withdrawing your pension early, other than a very small amount of extenuating circumstances. So it isn't the most flexible. And it's really important to remember that there is always an investment risk. So with all investments, that money, your capital, is at risk, and the value of your pension is going to fluctuate and go up and down over the course of your working life. That being said, the longer you've got until you retire, the more time you've got to ride out those waves and those fluctuations in the value of your pension. So it is worth keeping in mind that there's a risk, but it's also worth remembering that you hopefully have got several years, if not decades, to navigate that. So here is a big question. It's a question that's quite popular. A lot of people are asking this question at the moment. Is my pension doing any good? And I think we've got a poll as well about this, which is going to ask you guys if you know where your pension is invested. So I'll give you a couple of minutes to take part in that. Okay, so it's looking like most of us at the moment are no. Got a few people with a rough idea. Got a few people who do know, which is awesome. Give it a few more seconds. If anyone hasn't voted yet, then here is your chance. Okay, so we've got 65% of people are not sure where your pension is invested. So this kind of puts into context this question even more. Is your pension doing good? If you don't know where it's invested, it's very unlikely that you're going to know that answer. And as I've put here, you know, whether it's cutting down meat consumption, whether it's switching your energy to be more green, carbon offsetting, then more and more of us are much more aware of our impact on the environment. But one major factor that we often don't think about is our pension. And we can be funding oil companies, tobacco companies, without even knowing it, simply through our pensions. So let's talk about that. The danger of the default pension fund. So most pension providers, particularly workplace pensions here we're talking about, automatically put your pension when you are auto-enrolled into a default fund. A default fund is often going to be a tracker fund, so it will simply follow an index like the FTSE 100, which is on the stock market. And that means that your money could well be invested in industries such as tobacco, fossil fuels, and far more industries which are damaging to the environment or that don't align with your values and your social conscience. So it is really problematic, but 95% of employees leave their pensions in the default fund. And other than the issues that I've mentioned here with the default fund, that it might be invested in areas which are like potentially harmful to the environment or to society, then the default fund also often does not perform particularly well. It's normally a very medium risk fund. So by leaving your money in a default fund, you can be funding these industries and you can also be potentially losing out on growth, which can be really valuable over the lifetime of your pension. So what can we do about it? So there are three key things to think about. First of all, if you don't know any of your details about your workplace pension, get hold of those. So find out who your pension provider is from your employer, and you should have login details, but if not, speak to your HR team. Once you've got those details, contact your pension provider or log on and find out where your pension is currently invested. Depending on which provider it is, it should be relatively easy to find the right contact or to log on and to find out that information. Also, you can speak to your employer. So if you do that and you find out that there are not great options with your workplace pension provider, if there aren't potentially green options or more sustainable investment options, speak to your employer. Talk to them about the options that are available out there for net zero carbon funds, because there are some. And the more people that speak to their employer and that raise this as an issue, then the louder your voice is going to be. And also speak to your colleagues and educate each other on the influence that your pension can be having on the environment and on social issues that you care about. I'm sure lots of you here have got issues that you're really passionate about, whether that is labour, whether that is the environment, whether it is oil, gas, whether that is arms, all of these issues. Talk to your colleagues, educate them about the fact that your pension, if you don't move it, or if you don't at least ask the questions and find out where it is, could be funding these industries. So open up that conversation and you can really make a difference. And I've spoken to several people who have been through the process of changing their fund with their provider. And a lot of providers now do often offer more sustainable fund options for their pensions. A lot of people have found it super simple just to switch over, but it just requires a little bit of effort from your part because the pension providers are a little bit lazy. So speak to your HR, speak to your pension provider, speak to your employer, and speak to each other about these options. And finally, just to kind of wrap this up before we get on to some questions, lots of people often say, I think I've got an old pension from my old workplace. Where is it? Is it lost? How do I find it? So The good news is if you do think you've got an old pension from a previous job, then you can track it down, and there are two options. Either your current pension provider, if you speak to them, can help you to track it down, or the government actually does have a pension tracing service, which is free. It's not the quickest, but it does work. So if you're not sure where one of them is, either speak to your current pension provider or have a Google, get onto the government pension tracing service and fill out the information there. And once you do locate your old pension, you've got a couple of different options. You either can leave it where it is and have those details so you can access it once you reach pension age, or you can consolidate it and combine it with your current pension. And there are pros and cons of that. We're going to talk about those in a minute, I think, in the questions. We might have a few of those, but you can consolidate your pensions to put them into one place so that they're easier to manage. If you've got any questions specifically about that, though, then please do put them in the Q&A and I can go into more detail about that. But for lots of people, it's a sensible option so that you know how much you've got and you can keep track of what that pension looks like for the future. So the good news there is no pensions should be lost. And actually, you don't always need the details about the pension specifically. If you have date and the employer information, then most of the time these services will manage to track down your pension through those details.